Well, welcome everybody to our session on financing clean tech innovation. Thank you first up to VCC for holding this expo. I wish at the outset to acknowledge the traditional owners of the land we meet on, which in my case is the Wurundjeri people of the Kulin Nation, and pay our respects to elders past, present and emerging. The format of our session today will be a speaker on the topic of navigating sources of clean tech capital, followed by a panel discussion. My name is Joseph Unane, and I'm chair of the Victorian Clean Technology Fund. I've been involved with numerous Australian R&D companies and startups, and have been involved with VCTF now for some 15 years. VCTF was established in 2003 with Victorian government funding. It's an early stage investor in sustainable energy, greenhouse gas reduction and clean technologies. It's a novel structure, being an evergreen fund, and we invest at the seed and pre-seed stage, which is at the high risk stage and a high risk space to invest. And all of the returns from our exits get reinvested into new opportunities. We have invested in a wide range of clean technology applications, and we currently have investments in solar sharing, alternative fuels, hydrogen, green gas, and waste. Check us out at vctf.com.au. Today's panelists are Roger Harley from Faulkner Capital, Phil Bailey from Climate Capital, Alexandra Clunies-Ross from Artesian, and Rachel Young from Giant Leap. I'd like at the outset to introduce Roger Harley as our speaker today. Roger's a very experienced professional in the banking, finance, and venture capital world. I'll invite Roger to step in, tell us a bit more about himself and Faulkner Capital, and speak on the subject of navigating sources of clean tech finance. Please remember to post any questions you have in the Q&A space, and we'll try to address as many as we can during the panel discussion. Over to you, Roger.
Thank you, Joseph. It's a delight to participate in this conference. Anna is supporting me, putting some slides up, so Anna, if you wouldn't mind just putting to the first slide. I've had quite a lot of fun actually preparing. We'll go for that, so that's just me. We'll go to the second slide and actually preparing these. And what my objective is to give you an understanding of who the different classes of investors are. The angels, the seed, and VC especially. And because I've worked for too many years probably in the space, I can actually give you I'd like to give you a bit of insight on who they are, because you've really got to understand your market, and then that will inform some advice I'd give you on how to pitch to them. So going to the first slide, I've got three diagrams there. No, sorry, the next slide. The first slide is what you'll be familiar with at the top, right? So you've actually got who the different investors are. You've got grants, and that is a very productive, and I really sort of admire both the Victorian government and federal government for now making a lot of grants available in the space. But then you go to angels, seed, venture, and public investment. So that'd be familiar with you, and I'm going to talk specifically later on slides on the angel, seed, and venture, who they are and how to approach. But what I want to just reflect is I quite like the term that we were given, which is navigating clean tech finance. And I think people would be entitled to think what does navigating finance look like? It's a bit like what's on the left, that diagram on the bottom left, which is you start off in the mountains, a bit like you've been fur trapping, and you've actually got to sort of navigate your venture down to the ocean where the big riches are. And you start off therefore with your family and friends and your grants, and you get further down, you've got your angels, then your seed, and you're stopping off to get these different bits of venture and partners. And you'd be entitled to actually think that it's a well-worn journey, and all you need to know is a little bit of how to navigate down the river, right? And that's what I can tell you about. But what I want to do is reflect to now the diagram on the right, which is if you spend time talking to people who got crashed on rocks coming down that pathway, then there's a lot to be learnt, because the typical journey is not getting to the bonanza to the end. It's actually crashing in a very painful way. And so I just thought I'd put it out there at the start. And so look in the dot points I've got below there, it's a ridiculously difficult journey. And why, I don't want to put you off, but I'm saying failure, the prospect of failure needs to be boldly evaluated. And usually it means that you only start if you can bear the risk. If you can bear the risk to your professional career, you've got this psychological makeup to be able to take that risk. And you've actually got a commitment. And just the last point is that you've got to really be philosophical about it, that if I do crash, have I lost everything? And I suppose I'll come to the final slide and I say that the delight of working in the space is, even though a lot of us crash or be involved or partner with people crash, the journey, what we achieve because of the purpose is well worth it, because the environment benefits and our community benefits by failure of people coming down that journey, where we read about the success stories, but the people who don't get there are important in actually delivering the overall result. Thanks. So if we go on to the next slide. And so one of the things, before I get on to the seed and the different categories, I do want to just take this navigation analogy a little bit further and to say, well, look, it's coming down from the mountains. You might start off in a 1 or 2 man boat, as like on the one on the left. And then you build your team, right? And you'll get to, and if anybody's a rower, and I can't say I'm a great rower, but there's a totally different skill of being in a 2 man boat to an 8 man boat. And then you get down to the further, and what you really, to get to the end where you're going to be doing something that's globally significant, have global impact, you'll get down to that America's Cup crew, New Zealand one on the right, which has got global talent. That somehow the crew that you start off with has got to translate to something equivalent to the America's Cup crew. And so and I say the initial crew is you've got the founders part of it. And as we all know, founders aren't wired as normal people. To me, they're more like a Shane Warne of this world. And so they're not necessarily people to work as teams. But the key point I want to get there is the second slide, that you're going to lose people with crabs. People are going to go from your team. They could be your best friend, right? And they could go out because they get caught in something, or you push them out because they're not the right person to get you to the end point. And that's one of the reasons why I said before, this can be a brutally difficult industry. And that's one thing that you need to get your head around. And I've seen the scar tissue that has even seen, couples have worked together, have actually got divorced. And it has ruined friendships and end up court battles. So the crew is key, right? Let's move on to the next slide. So I just wanted this, and we'll circulate these slides just about me, because I've actually I've covered investment, fundraising. I've been involved with all the government VC programs for 11 years with roles with Innovation Australia. I've got a global whole perspective on this is probably a little bit unusual. I am a strategic advisor in the cleantech sector to Hydroterra, as one of the members of the cleantech cluster, which I'm very proud of. So we move on to the next slide. So just talking about angels. So who are they? Well, the key thing is, they're family, friends, high net worth individuals, basically people are putting in 50, maybe 100, 200 grand. They're the first investors. And the key thing about this is that why they're coming in, they're coming in because they trust, they like the proposition you're putting up, but they trust you. And with that, you want to therefore be clear to say, well, who do I want in that? Because, can they bear the loss without retribution? Right? And are they also prepared to, they need to be pretty flexible with you, because generally when you start out, your whole program is not fully developed, right? And so it's not about saying, I'm going to do this and this. It's a real trust. And so that's where you've actually got to say, well, who is it someone I can trust and has got the ability to wear the loss and has got the personality to support me through this? And so that really narrows it down, where you might have quite a few friends there. Usually you'll take a lead. You'll find someone who'll be the lead angel, and then you'll follow it up with what I call is cheer squad angels. But that first one is you negotiate the terms and the basis. And the key other point here is legal documents aren't everything. It's more actually articulating the principles on which you're going to be taking their money and you're going to be working and what you're going to deliver to them. And it's important to come back to the principles of your engagement with them more so than the legal documents. So if we move on, so the last point is, you like that little red, I've got a red angel and a red, that some of the angels become devils. So really be wary of who you select and find out what their experience had been in other angel investments. Right, so we've got two more classes. We've got seed and venture. And there's interesting, the seed is a mixture of people who can be follow-on family and friends. They can actually be some of the government-supported programs. There's a whole ESVCLP group, which has come from, that takes advantage of tax loss, tax status by registering with the Australian government. And you can get that list from going to the biz.gov.au. The Australian Investment Council, which used to have AVCAL, has got a list of investors. And you can sort that by stage. So I'm saying there are two places to go. Probably one of the key places to go is find people who have invested in something similar to you successfully, right? Because they're what I call empowered investors. And the trouble here for the seed investor, who might be putting in, say, 200,000 to maybe 1.5 million, when you think about it, they don't have enough at stake to really be able to do a lot of due diligence. Their business model is their hybrid between a venture capitalist who's got the professional investment behind them to be able to do due diligence, and the family and friend investor. And so what that means is that for these guys, you need someone who's empowered to invest from what they've done before. And also they're looking for validation. They can't independently validate your claims. So what you're looking to do ideally is find out a lead seed investor who is, in a sense, validating the proposition for the others. So you get a lead investor and say, because that person's in, the others come around. So again, with how you do this with both your family and friends and seed, is you get a list of people who said they're interested. And once you've got that validating investor and you've agreed the terms, you fill it out with the others. Key point here is that you want to be, you're moving to some professional shareholders agreements. They'll want that to protect them. You want to outline your ESOP at this stage. And just be careful, though, that you don't have terms of converting notes or whatever that will poison you for venture investment. So we move on to the last group. Just a couple of minutes, running up a couple of minutes over time. So one of the key things, so the venture capital fund managers, let's say a typical one has got investment of $80 million. They'll invest in 10 investments, maybe about $8 million each. But they don't have, they've got about $2 million to fund themselves every year. So it's a tough business, and their only key thing there, they're looking for someone who's going to get 10 times money return. So they're not looking to back anything that's not going to really move the dial for them. So your investment proposition, they're going to qualify immediately. Can they see this going to be a 10x return? The key thing you want to look there is, rather than say, who are the VCs, which one do I want? You want us to map out your path from C to D and forget from here to there, what is the best venture firm that's going to help me do that? You know, have they got access to markets for them? Have they got access to clients? And that's where this image of crossing the abyss comes to. That what you do, the best way to engage with a venture is, I've identified you because you're the best partner who can help me get there. Typically, it's a two-stage process. That you'll actually have a term sheet, and there'll be extensive due diligence. So be prepared. You need to have all your ducks in the water, and these guys might spend $200,000 doing due diligence on you. So you got to be prepared, but they can be the absolute partner to accelerate you across the abyss to make you a global success. So going to the last side to sum up, what is this navigation look like? The best thing I could tell you is a I hope you like that, the snakes and ladders, because but where the scorecard comes in, I'm saying there are two ticks and one question mark. The tick is, by you engaging in this game, which I fully want to support you to do, the environment will be the benefit, because we've got to push forward with all these venture and disruptive ideas to be able to see, to get winners and to really make a difference. So whether you fail or not is irrelevant to the fact you've advanced the cause. The second thing is, you're going to be working with some wonderful people who are highly motivated, who are doing things that you care about, and you're in the trenches together of it, if you like, the war of today. And you want to be able to tell your kids that you've fought that war. And the final one is financial return. Well, that's uncertain, but it's well worth, and and those people do succeed. Sometimes it's as much luck as the people who have failed. So I'll circulate that the presentation, and look forward to actually hearing from some of our panel members.
Well, that's great. Thanks, Roger, for an enlightening presentation. I found it particularly interesting to look at the landscape as a journey through financing, with clarity on each of the steps and the pitfalls along the way. A reminder to everybody in the audience to pose questions in the Q&A. And now I'd like to introduce our panelists, starting with Phil Bailey, who's a senior investment advisor at Climate Capital, with a strong focus on renewables as well as previous experience in infrastructure solutions. Welcome, Phil. Could you tell us a bit about yourself and Climate Capital? I think you're muted.
That'll be better.
Yeah, that's
Thanks
better.
for that. It's natural working in a co-working space that there's a lot of people around. There's not necessarily any booze. There's a bit of background noise. So, look, my work in Climate Capital, we're a reasonably small renewables developer. What we're aiming at is projects that are around 5 megawatts, which is roughly $7 million a pop. We've got a pipeline all around Australia. One of the interesting things that we're doing is, or two things probably, we are very much focused on the corporate market. So we are trying to sell our power to established businesses rather than into the market and taking that sort of market risk. But the other one is that we're 100% equity funded. So speed of execution is critical for us. It's all about solar farms, but we do look at other opportunities from time to time. It's funny, we were established, 4 years ago. We've got independent funding from impact investors. We went through that startup phase, but we do get presented with other investment opportunities from newer startups. For instance, we looked at one over the last few months in solar recycling, and the project fundamentals were sound, but which is obviously the number one thing that any investor is going to look for. But there was some misalignment between some of the incumbent shareholders, and that was creating friction, which we were aware of. So ultimately, we didn't go through with that one. But it's sort of a broader lesson for anybody looking for funding. You've got to make sure that all your ducks are lined up internally before you can actually go to the market. While that project or that business was sound in principle and the numbers were great, I'm not sure we'll ever get to market for those reasons. The other work that I do is I work in a small corporate finance firm called Peloton Corporate. We generally focus on the equity side. Our core business is valuations. And we do some for startups. We've done a few over the last year or so, which is obviously challenging. But we also do transactions work, and that's focusing on more mature businesses and infrastructure. But a lot of that is actually in clean tech. So I guess I can bring a broader perspective to where some of the clean tech solutions might end up in a few years' time. For instance, one of the things we're working on is energy from waste. We do some other work in the waste sector. We look at solar farms. We've been approached to support startups with funding. We haven't jumped on any of those. It just wasn't our natural sort of space. But we also we had an opportunity for a solar farm recently, and they were seeking pre-development funding, but they were struggling to explain the business model, and there were some heroic revenue assumptions, as you can imagine. And look, there's nothing necessarily wrong with heroic numbers, provided you can back them up. But having worked in the energy sector for close to 20 years, I could pull them apart pretty quickly. So that one was all about the fundamentals, and sort of in contrast to the solar recycling opportunity. In this case, and it was different because this was coming through our consulting business. The fundamentals just didn't stack up, and we politely declined to support them. But I think one of the other principles is that ultimately, unless you can secure some government largesse or some private benefactors who aren't looking for a return, ultimately all the funding is either debt or equity, and it's important to keep that in mind. Some people I've come across have thought about convertible notes as a bit of a free ride. That's certainly not the case, because investors will still look to the fundamentals. So I might leave it there and leave to Ali and Rachel.
Good, thanks, Phil. I think that experience will certainly add some colour in the Q&A coming up. And we might throw to Ali to tell us a bit about Artesian and herself.
Thanks, Joe. So Artesian is an alternative asset manager. We have two products. One is fixed income and one's venture capital. And on the venture capital side, we have about $450 million under management. And one of our funds in Australia is a clean energy fund. So we focus on investing in energy efficiency companies, renewable technologies, as well as low emissions technologies. So the intention of the fund is to invest in seed and Series A style companies that are trying to commercialize technologies that reduce emissions. I'm the portfolio manager for this fund. So we have invested in just over 60 companies to date. We essentially fill the gap of between grants. So talking a little bit about Roger's presentation, we fill that gap between grants and late stage venture capital funding, because we invest in companies often that are pre-revenue and that have a level of technological risk. So they say that clean tech have about 4 valleys of death, from lab to taking it to post-lab and testing, to pilot, to commercialization, and then to scaling that business. So we sort of play in the lab and pilot phase of a business, and we invest in a range of different types of technologies, so software, deep tech as well, because climate tech investing can be relatively capital intensive. And just to give you sort of an example of one of the companies we've invested in, we invested in rapid solar deployment company 5B. We invested in their very early stage seed round. We've followed on another 2 times since then, and they've just done their first overseas project, and they're starting to expand overseas now and deploy their solar panels. So they now have a large corporate as well invested alongside us, but we saw ourselves as that sort of initial cornerstone investor to enable that technology to grow in Australia and then grow globally as well. And we also, one of the cornerstone investors in our fund is the Clean Energy Finance Corporation. So we sort of see ourselves as filling that early stage gap while they make the later stage investments in this space.
Look, thanks, Stanley. That's a comprehensive summary. Clearly, you've got a lot of experience in the clean tech startup area. Just throwing back to Roger's presentation, and your mention of Series A, I just thought I'd clarify for our listeners that Series A is the first round in a venture capital investment along that river of navigation. I should also point out that VCTF and Artesian are co-investors in a couple of startups. Finally, it's my pleasure to introduce Rachel Yang, who's an investment manager at Giant Leap, where she has a focus on impact investing. So, Rachel, welcome, and please tell us more about yourself and Giant Leap.
Thanks, Joe, and thanks for having me. So, Giant Leap is an impact-focused venture capital firm. So we invest in early-stage startups that have a focus on environmental benefit, as well as being commercial and scalable. So we target the same returns as traditional VCs. So we co-invest with VC firms like Artesian, and we have a couple of investments together. We're a sector agnostic fund. We invest across 3 themes: sustainable living, health and wellbeing, and empowering people. We have roughly 19 companies to date. We're looking to raise our next fund soon as well. And so we've focused across those 3 themes pretty evenly. And in the sustainable living space, which is most relevant to this clean tech audience, we have a couple of investments, examples being GoTerra, which breeds black soldier flies to consume organic waste. So they're effectively a maggot farm that focuses on waste management, and they use robotic technology to breed those maggots. And then we have another business called Amber Electric. So they're an energy retailer that looks to challenge the way consumers can access energy by providing access to the wholesale price for electricity and basically charging a monthly fee for that. So that means it incentivizes customers to use energy when it's the cheapest, which is typically when renewables are on the grid. Another example is full cycle bioplastics, which is based in the US, and they've created a technology to turn organic waste into biodegradable and marine degradable plastic. So we've got quite a range of investments. We also invest at the seed and Series A stage as well. We do require businesses to be post-revenue, so generating at least $1 of revenue for the seed stage investments. And beyond that, our benchmark for Series A is roughly $1 million in annualized revenue. So that gives a bit of a benchmark for the audience.
Excellent, Rachel. Look, thank you for that. Looks like a very rewarding investment area to play in, particularly the sustainable living space. Look, now that we've met all of our panelists, let's dive into the discussion. And maybe we can kick off with a fairly common question from the audience, which has come from Rosalind Anketel, which is, what are the most important features and messages to highlight to a potential investor to get them over the line? Perhaps we can start with you, Ali.
So I guess that's a great question, and it's a question we get a lot. I guess it depends on the stage of the business and how much capital you're raising. So if you're raising more capital, you're a bit later stage, it's important to show that there's validation and that there's traction. So, Rachel was just talking about annualized revenue. So we typically would look at revenue, but we also look at other things like orders. We might look at pre-sales, number of users, etc. So that's sort of once a company does have traction. If a company is deep tech and is at an early stage and is trying to commercialize, that's their first round of funding to commercialize that technology, we want to understand what that IP is, why it's novel, why it's going to benefit or improve the specific problem or area that it's working in. And then, of course, looking at the founder and the founder's ability to execute potentially their domain expertise as well. So that's probably 7 or 8 things.
Look, thanks, Ali. Roger, do you have a perspective on the right messages to highlight to investors?
Yeah, the only thing I'd probably add to what Rachel was saying, which is that it's just very difficult for the VC to validate the engineering or the IP, and so it's just the more you can actually find an independent validation that does that work for them. Otherwise, sometimes it's too hard. It's just not. And also the competition in the market. So that's one of the really scary things now, is to say, well, you might have something there, but how do we know who else is doing this globally? Yeah, maybe that's my only contribution. So
you're suggesting that some analysis of the market and competition is a very important thing.
Or it's finding maybe a partner. You've got some engagement with a sort of a go-to-market partner that you've actually shown that that they might not be there, but you've actually got something from there that shows that they've got a significant interest. And you use that partner's analysis, they'll share that with you, with the investor.
So
and also, I'd also look at, in this field, corporate venturing is really developing. And so, partly people trying to get an early stage of securing a corporate venture partner is something I'd also encourage.
Phil, you've got a comment to add here?
Yeah, I'm actually working with a client. We're about to kick off, but I've known them for a long time, so I know what a lot of the issues are inside the business. And it's really interesting. It's sort of switching from where they are. They've been operating sort of subscale for 8 years. It's really good for branding. The technology is proven, but I sort of said to the guys when I saw them last week, it actually feels like an 8-year-old startup. They're ticking along revenue, but what what we're really talking about is switching to a carbon focus, and that is going to drive the scaling rather than sort of what we might traditionally think about in the sort of purely revenue-driven sales, production, etc. Actually, this switches focus to a carbon model, which then opens up new funding opportunities. But of course, we then ask the same questions. Well, what's the competition look like? What's the scale of the market? All the fundamentals that we need to do. But over the next few months, as we sort of frame up all that analysis and document it, then we're moving into cap raise territory.
Thanks, Phil. Looking at another question, which is one that's on my mind, is quite often we talk about returns and what the venture capitalist or the investor or family and friends angel expects to make out of their investment. And so I wonder what your thoughts are about evaluating opportunities for exit with your investors. Perhaps Rachel's got a comment there.
Sure. So because we invest only for equity, the only way we can get a return is through an exit. But we do know it's a long game. So when we're thinking about the exit opportunity, we generally think about trade sale or an IPO as the main options. We really, it's debated even amongst our team and a lot of VCs and investors as to whether or not you should discuss that with the founder, because the idea can be that you're kind of pushing them to exit early, or that founders that are talking about exit early are not committed to the business. So everyone has a different view on that. I think it's the responsibility of the investor to really think about in their own mind, in their investment thesis on the business, whether there is an exit opportunity and what that might look like in their own minds, rather than necessarily pushing that onto the founder. I think it's important to really have those opportunities available, but we also don't know what the world looks like in a couple of years with the advancements of technology and the ever-increasing number of startups. So we can guess what the exit opportunities could be, but the landscape can look very different in just a couple of years.
I suspect you'd also want to at least have an alignment between your thinking about exits and at least establish that the founders or the owners or management have similar timelines. Some of you operate in closed-end funds, with dates where they're all over, and I presume you're looking at investments that don't continue to limp along indefinitely. Ali, do you have a view?
Yeah, I mean, Rachel's right. It's not something that you want to kind of come in and say, great, I'm interested in investing. How am I going to get out? Because it's a journey, and it's a really long-term journey. It's years and years of a relationship between a VC and a founding team. So it's important to have that relationship right. I often talk to founders about, what they want out of this business. Do they want to run an ASX-listed company? Do they want to sell it to a big corporate? We also can exit via secondary because we get in so early. So often, when a company if we got in at pre-seed or seed, a company gets a Series C or D, we can exit. We don't need to force that liquidity event. So in that regard, I think, again, like Rachel was saying, you don't want to have to force an exit when a company is not ready. So getting out at that secondary, and a number of funds look at that. I mean, VC in general, we just saw that secondary exit through Blackbird's fund. So it's not unusual, and it's a way that a company can remain private if they want to. But yeah, I think just aligning what the founder wants out of their business is important, just to understand, and so that you don't come 5, 6, 7 years down the road and have a big block because there's misalignment.
Okay, I think Roger's got something to add on this one.
So just from someone we advise on exits, is that one of the key things as a VC comes in, part of their due diligence is focused on making sure there's nothing there that would prevent an exit, that would spoil it. And so one of the key things there is ownership of IP, right? And that's very clear that the provenance of the ownership of IP is fully detailed, and because they're saying is if I've got a corporate buyer for this, that's what they'll be doing. The other thing to look at is, has there been any fallout between key employees that hasn't actually been fully resolved? And that's often something that can have claims and counterclaims, and that comes into, so again, the VCs like Alex and Rachel actually requiring a level of corporate governance and companies to get that there, because again, that's what someone looking for an exit, whether it's an IPO or whatever, is that's those board documents and everything being a much higher level than you'd actually have maybe for a seed round or a different round. And so corporate governance becomes very important.
Look, thanks, Roger. You might be best to stay on for this question from the audience. This one comes from Peter Hansford, which is, given the relatively low level of understanding of capital raising by SMEs, how do these companies obtain guidance as to the best pathway to follow?
One of the starting points I always have is find someone who's similar to you, who's actually had a successful journey. Learn by other companies, right? So do your homework, find out who else has done something and follow their path and look at their journey. And that's, you can do that without paying an advisor. So firstly, and for most of these things, and that's where also for the investor, you're looking for an investor. So who else has made money investing in this? Because to me, they're the empowered investor and they can add a lot more to you.
Look, thanks, Phil. We've only got time for a couple more questions. One that I want to throw into the mix is, what advice can you give to companies, entrepreneurs in terms of the pitch deck itself, which is often the first thing we see? So feel free to jump in.
I'm happy to jump in on this one. I think clarity of messaging is really important, and it kind of leads to the first question around what key messages you should highlight. I think first and foremost for me is, what is the problem that you're solving? And I think a lot of people miss that because they go straight to their whiz-bang solution and talk about how great that is without actually talking about the problem and the willingness to pay for that problem, because investors are looking at the market opportunity and the ability for 10x growth within that market. And so without understanding the problem and the number and quantum of people willing to pay, it's very hard to see that 10x possibility. And so having that clarity of messaging throughout and keeping it very simple, because really you don't have to share everything at once. The deck is to provide the key messages. So I would say kind of 10 slides and no more than that, because, for us, we see around 1,000 deals a year. So we don't have a lot of time to trawl through pitch decks. So I think, again, going back to it, clarity of messaging in short, simple slides.
Good. Thanks, Rachel. Look, we'll take one last question from the audience. This one's from Alex Veal, and that is, can venture capital effectively be used to nudge government policy, particularly around clean tech climate, in a more sustainable direction, or is VC bound to seeking returns under current policy settings? That's a big question, right?
I can have a go at that,
Yeah.
Joe. But one way of thinking about this is all my experience in energy and renewables. My perspective, and a lot of people in the sector say, it's focusing on the project and the fundamentals, and I'll keep coming back to that. But where we are now is all the investors are acting in spite of the government And it's really just one of the risk factors that we always need to look at, on top of sort of everything else in the project. Whereas 5-8 years ago, whatever it was, when there was a lot more carnage around renewables and the renewable energy target, et cetera, which the government was trying to destroy, that put a freeze on funding and investment. So I think where we are now is that investors are driving the changes and will continue to do that, and the government needs to follow, whereas 5 or 8 years ago, it was more reactive to what the government was doing.
Okay, thanks, Phil. I think that is a good perspective on that and a reasonable answer. I'd like to thank our panellists and the audience for a stimulating discussion and QA today. I think we've learnt that, at least what my takeaway messages were today was to focus for our companies to focus on clear messaging, and also when looking for investment to seek out similar businesses to theirs and seek to understand why there's been investment in those businesses, and also who else might who the investors in that business, which is similar to theirs, might be interested in investing in that. So I think that there's some strong messages coming out of the discussion and Q&A. We have a number of startups pitching actually at 3 p.m, another 5 startups in the lightning pitches. So the audience may want to stay around and listen to those pitches. Finally, I'd like to thank again VCC for running the Expo and remind you to visit the exhibitors themselves in their online booths in the Expo, which you can get to via the button on the left-hand side of your screen. Thank you again to all the participants, and goodbye for now.
Thanks, Joe.